Hi there. Thanks for taking this course on wave analysis. Wave analysis is more than 80 years old theory developed in the 1930s by Ralph Nelson Elliott based on his observations with respect to the financial markets. The gist of the theory is that financial markets exhibit a patterned behavior, and this theory helps us in recognizing the pattern. Now, before we actually get into the theory and its various facets, I want to share some recent examples of application of this theory in the financial markets. The course itself would be covering a lot more examples, both from a positional trading and day trading perspective, and also from a long-term investing perspective. But the reason I am sharing a few examples before I start with the actual theory is because I want you to realize how powerful insights can be derived by application of this theory. And ultimately I am hoping that this motivates you to persevere through learning this theory and start applying it. The first chart we are seeing is of gold. The chart was issued by us in December of 2015. There was an amazingly bearish sentiment prevalent in gold prices at the time. This chart here shows the basic pattern of wave theory. This basic pattern is marked as 1, 2, 3, 4, 5, this kind of a labeling. Also, this chart shows some other patterns associated with the theory, like the triangle pattern shown here and the ending diagonal pattern shown here. Using the wave theory, we predicted that gold prices may have already bottomed out, and we actually issued a target of $1,343 for gold prices in 2016. And this is what happened subsequently. We saw a major rally beginning in December of 2015 itself, and by the end of June of 2016, a target of $1,343 in gold prices was hit. The next chart is of a leading emerging market index, which is the Indian Nifty. This chart was issued by us in January of 2016. The two lines drawn here actually contain a pattern known as the ending diagonal pattern. Using this pattern as per the wave theory, it was predicted that the Indian Nifty was to rally by close to 350 points. And this is what happened immediately after we issued this chart. In a span of just a couple of weeks, Nifty ended up rallying as predicted by the pattern. The next chart here is of a gold loan company that had been in a deep correction for quite some time. In second half of 2015, it was down by over 80% from its peak price, but it was exhibiting a very basic wave pattern, which is shown by the labeling here. The pattern basically said that we have seen a major rally followed by a major correction marked as ABC labeling here, and the conclusion according to the wave theory was that this stock was all set to rally much higher and probably turn into a multi-bagger. And this is what transpired next. In just 1 year, the stock had moved from sub 20 levels to 90 plus levels. Now throughout this course, I will show you numerous examples from stocks, currencies and commodities, essentially to demonstrate the power of the theory and also the effectiveness of numerous patterns that form a part of this theory. With this in mind, let's formally start the more theoretical aspect of Elliott waves. See you in the next lecture.